In this video, I'm going to talk about the Perpetual inventory system. And I'm going to specifically address a question that was given to me by Rashid H1. And if I did not pronounce your name correctly, please leave me a comment, let me know. But in the meantime, this gentleman asked me about stock record cards, and I actually had to order a book. That's why this video took so long. I actually had to order a book that would tell me what these things were. But this all has to do with retail inventory. Now, I had talked about this not only when I talked about the Telzon in a previous video, but I also talked about this when I talked about LIFO and FIFO in yet another video. Alright, in a perpetual inventory system, what you're going to do is you're going to keep a constant count, practically hour by hour, of how much inventory is on your shelf and how much inventory is in your back room. Now, this becomes economical. Now, in the old days, this was not a very economical system because you would have to hire a whole bunch of people to keep a whole bunch of counts for a whole bunch of time. And it just became very impractical, especially if you carry thousands of pieces of merchandise like Walmart does. Well, then came the advent of computers and databases like Access and Oracle and SQL and so on and so forth. And when that came along, this became a lot easier. But let's talk about how they did it in the old days with stock record cards. What they would do is, because you'd have this merchandise inventory, you'd have a subsidiary ledger. And this subsidiary ledger would have stock record cards, like this one. And what you do is you put on the top of the card the toy number. Now, nowadays that would be UPC number, but you'd have your own particular number here of the toy. You'd list the location. In this case, we're listing the location as where it would be on a store shelf, as opposed to something in a back room. And the reason why I do this way now is because a lot of companies are not keeping a lot of back stock in their back room. It's just becoming impractical and not very cost effective to have a whole bunch of inventory in your back room. It just doesn't look good on your balance sheet and income statement and so on and so forth. It could be a real drag. It could give people the wrong impression that you're not a very profitable company, so people don't like to keep a lot of stuff in their back room. Alright, so now we're actually listing it, like I said, on the store shelf location. Now, you have a description over here, and the description of this item is a toy truck. Okay? Now, you have this first column over here, and it shows the date of activity. Now, these dates would be the activity of whether you're receiving these toy trucks from a manufacturer or then selling the trucks to your consumers, alright? And the date of each one of those transactions would be kept right here. And like I said, this is a lot easier done through a database than it is through a stock record card. But anyway, you'd have the date of the transaction. The received is when you'd receive the toy trucks from a manufacturer, okay? So you have the number of units of trucks that you received. Say you just received 1,000 toy trucks from the manufacturer. You'd put down the cost of each truck, and then you'd put down the cost. You take the cost of each truck times the number of trucks that you had and put down the total cost. Now, issued actually means the time when you would actually sell the toy truck to a consumer. And then what you do is you put down the number of trucks that you sold, how much each truck cost, and then you take the unit cost times the number of units that you sold to come up with the total cost. And then, of course, you'd have a balance here showing how many trucks you'd have left, how much each truck cost, and then the total cost of each truck. Alright? And that's your stock record card right there. And like I said, nowadays you wouldn't use stock record cards. You'd actually have this all in a database. So that's where all of this comes from. And perpetual inventory systems are really good these days because, like I said, it keeps your inventory down in your back room, which in turn shows more profitability for your company. Now, when you're doing the issued right here in the center, right here, the issued, the thing is you would do this either with the FIFO method or the LIFO method of accounting. Preferably the LIFO method, because that would keep your taxes down and make your company that much more profitable. Okay? So that's the way this stock record card works. And like I said, you wouldn't use a stock record card anymore. You'd actually use a computer-assisted ordering system to do this. Alright. If you have any further questions about the perpetual inventory system, which, like I said, it would be cumbersome unless you had a database, which most companies have a database now. That's why it's not cumbersome anymore. In most companies these days, what they'll do is they'll make an initial count of how many items they have on a store shelf. Possibly if they have some in the back room, they count those as well. And what would happen is when the item was scanned across the cash register, it would deduct that out of your inventory. And when your inventory went to a certain level, then the computer would automatically order more merchandise to be brought into your store so you can continue selling. That way you're not having to figure that out for yourself. And that saves a lot of man hours. The only problem is when you have that kind of an inventory system, if somebody steals off the shelf, that means that the item didn't get scanned, it didn't get taken out of inventory, so your computer thinks you actually have inventory, which you do not have anymore because somebody stole it from you. Or you could have a situation where something was broken. Let's say one of the toy trucks was broken. Well, if you don't take it out of the CAO inventory, it's still convinced it's there, and therefore it doesn't order new merchandise. And either you run out of merchandise and the customer's mad at you because you've ran out of merchandise, or the CAO gets thrown off in a different direction and it thinks that you have no inventory when you actually do, so it orders more inventory. And so therefore you have a bigger, higher cost. Either way is a bad thing. So you really have to kind of keep an eye on what your computer thinks you have on hand as opposed to what you really do have on hand, because then you can end up getting a lot of merchandise you don't want, or you may not get enough merchandise to continue your sale. Either thing would be really bad. Alright, if you have any further questions about perpetual inventory system, leave me a comment and I'll do my best to help you out. Alright, this is me signing off. I will tell you more in a future video, so stay tuned.